Fed Chairman Jerome Powell will address lawmakers in his first semi-annual testimony tomorrow, giving markets their first chance to pass through every word from the new Fed leader. Here's what some investors expect to hear.
He's going to try and emphasise continuity, gradualism, but I think it's going to be hard for him not to sound a little bit hawkish, given the backdrop, both in terms of inflation and in terms of growth.
I don't think the Fed is going to change its stance, because the Fed has been saying we are looking for inflation to normalize and converge towards target, and on that basis, that's what we expect to do. So we're moving there now. The risk is that at some point, as inflation gets closer to target and they look at the future possible outcome, they decide to shift to a slightly more hawkish stance.
I think that he's going to have his eye on financial stability more so than we've seen from other chair people. And so with that in mind, even though they don't see risks to financial stability today, if financial conditions continue to ease as they are trying to tighten monetary policy, that will change.
He has to be really careful about over-hiking, late in the cycle here, as the enthusiasm, as Matt said, continues to go up and not take away the punch bowl.
Joining me around the table is Nick Bennenbroek, Wells Fargo Securities Head of Currency Strategy, and I'm really pleased to say back with us is Paul Richards, Medley Global Advisors President. Paul, let's begin with you. I want to establish the market bias, the overwhelming consensus going into this. Is it still that Powell is just Yellen 2.0?
You know, it's interesting, just listening to those commentators, every one of those is worried, which tells me, Jonathan, that tomorrow the surprise would be that we actually get a rookie that's not a rookie standing up there. He knows what he's doing. He sat next to Yellen for so long. I think his plan tomorrow is to calm the market from a perspective of stepping us away from 4. In January, the market was at 2, and the Fed was saying, no, look, we're going to give you 3. And then the market sort of skipped through and went to 4. The Fed is at 3 with the optionality of December being 4. If he can succeed in doing that tomorrow, and I think he will, I think the market's actually going to be quite pro-risk, and they're going to quite like this guy.
Nick Bennenbroek?
Yeah, I mean, I broadly agree. The market's pricing at 3, and I don't see, from a tactical perspective, much benefit from the Federal Reserve trying to shift the needle too much towards that 4 level. Keeping them at 3, if things turn out a little worse, they go to 2. If things turn out a little better, they go to 4. So I think we won't get anything new, more of the same, and possibly a dollar negative event.
Well, to pick up on Michael Collins' view over at PGIM, the idea that he needs to be careful not to hike too much, why would the Federal Reserve go more aggressively than they've already projected when the market is already up towards them and inflation is not exactly accelerating away from them in a big way, is it?
No, it's not. And I think this is the whole thing. The market's got ahead of itself. The Fed is just so much more patient than the market here, Jonathan. And I think at the end of the day, we need to get through this week, and I think we will. I think one of the important things will be March the 9th when we get that payroll number again.
Yeah.
That payroll data is going to be watched minutely, but I actually think he can get us through this week. The market's going to feel pretty good by Friday, and then we might wobble a bit in a week as we go into payrolls.